Imagine you suddenly have an extra $500 every month. You want to invest it. You open your investment app, look at stocks, ETFs, retirement accounts, and maybe even cryptocurrency. But then you ask yourself one simple question. Where should my money go first? Because here's the problem. Making money is important. But knowing where to put that money in the right order can make an even bigger difference over time. In this video, I'll show you a simple investment order that can help you build a stronger financial foundation and invest for long-term wealth. Let's get started. Step 1. Build your emergency fund. Before aggressively investing for long-term growth, make sure you have money available for unexpected expenses. Your car could break down. You could have an unexpected medical bill. Your income could temporarily disappear. If you have no emergency savings, you might be forced to sell investments at the worst possible time, or take on expensive debt. A common goal is to build an emergency fund covering several months of essential expenses. The exact amount depends on your income, job stability, and personal situation. The key idea is simple. Don't build your investment portfolio while your financial foundation is collapsing underneath it. Step 2. Deal with high-interest debt. This is one of the most important steps. Imagine you have a credit card balance charging you a very high interest rate. At the same time, you're investing money hoping to earn a return. That's like trying to fill a bucket while there's a large hole in the bottom. The interest you're paying on expensive debt can work against your financial progress. So after establishing an emergency cushion, prioritize paying down high-interest debt. Once that expensive debt is under control, more of your money can work toward your future. Step 3. Take advantage of your employer's retirement match. If your employer offers a 401k and provides a matching contribution, understand how that benefit works. For example, an employer might contribute additional money when you contribute to your retirement plan, up to certain limits. The exact rules vary by employer. But the principle is powerful. Don't leave available employer matching contributions on the table if you're eligible and able to use them. It's one of the most valuable benefits many workers have access to. Now comes step 4, increase your retirement investing. Once your emergency fund is in place, expensive debt is under control, and you've considered your employer match, you can focus more heavily on long-term retirement investing. For many Americans, tax-advantaged retirement accounts can be an important part of that strategy. One example is a Roth IRA. With a Roth IRA, eligible contributions are made with after-tax dollars, and qualified withdrawals can generally be tax-free. There are eligibility rules and contribution limits, so always check the current IRS rules before making decisions. The important lesson is: use the accounts designed to help you build long-term wealth efficiently. Step 5. Invest consistently in diversified investments. This is where many beginners make a mistake. They think investing means finding the one stock that's going to explode. But building wealth usually isn't about predicting the next big winner. It's about consistency. For many long-term investors, diversified investments such as broad market index funds or ETFs can provide exposure to many companies instead of relying on one company. Diversification doesn't eliminate risk. Markets can fall. Investments can lose value. But spreading your investments can reduce the risk of depending entirely on one company or one asset. Here's a simple example. Imagine two people each have $500 available to invest. Person A puts everything into one hot stock because they believe it will skyrocket. Person B builds a diversified portfolio and continues investing regularly. Nobody knows exactly what the market will do next. But Person B is focusing on a process instead of trying to predict the future. That's an important mindset shift. Investing isn't about knowing what happens tomorrow. It's about building a strategy that can survive many tomorrows. Step 6. Increase your investment rate as your income grows. Let's say you receive a raise. Instead of automatically increasing your lifestyle, consider increasing the amount you invest. Maybe you earn an extra $300 a month. You don't necessarily need to spend the entire $300. You could divide it between enjoying your life, improving your financial security, and increasing your investments. This is called lifestyle management. Because the goal isn't to never spend money. The goal is to make sure your spending doesn't grow faster than your ability to build wealth. And here's something people often underestimate. Time. A dollar invested today can potentially have decades to grow. That's why starting early can be so powerful. Compound growth means your investment returns can themselves generate returns over time. But remember, compound growth isn't guaranteed. Markets go up and down. Some years can be excellent. Other years can be painful. The advantage comes from having a long-term plan and staying disciplined. Now let's put the entire order together. First, build an emergency fund. Second, pay down high-interest debt. Third, take advantage of available employer retirement matching. Fourth, increase contributions to appropriate retirement accounts. Fifth, invest consistently in diversified long-term investments. And sixth, increase your investment rate as your income grows. This isn't a universal formula for every person. Your situation, taxes, debt, income, and financial goals can change the right strategy. But it gives you a powerful framework for thinking about your priorities. Now imagine your financial life like building a house. Your emergency fund is the foundation. Debt management protects the structure. Retirement accounts help build the long-term framework. Investments become the assets that can potentially grow over time. And increasing your contributions is like adding another floor. You wouldn't start by decorating the second floor while ignoring the foundation. Your finances work the same way. Build the foundation first. Then build wealth on top of it. And don't fall into the trap of waiting until you have thousands of dollars before you start. You don't need to become rich before learning how to manage money. Start with what you can reasonably afford. Maybe it's $25 a week. Maybe it's $100 a month. The amount matters, but your habits matter too. A small amount invested consistently can help you develop the discipline required for larger amounts later. One more important point. Don't invest money you may need soon just because someone online promises easy returns. There is no guaranteed shortcut to becoming wealthy through the stock market. Be skeptical of anyone promising huge returns with little or no risk. Real wealth building is usually much less exciting. Save. Invest. Diversify. Keep learning. Stay consistent. And give your strategy time to work. So if you're wondering, where should I invest my money first? Don't start by asking, what's the hottest stock? Start by asking, what part of my financial foundation needs attention first? That's a much better question. Because investing isn't just about choosing investments. It's about creating a financial system that allows you to keep investing for years. If this video helped you understand where your money should go first, make sure to subscribe to Roy Finance. Here, we break down money, investing, saving, and wealth-building strategies in simple language. And remember, you don't need to get rich overnight. You need a good plan, consistent habits, and enough time for those habits to compound. Thanks for watching. I'll see you in the next Roy Finance video.